Hi, today's topic is analyzing market history. As an investor or financial manager, you may be interested in how investments or different types perform over a period of time, or you may want to see how they perform relative to one another. You may want to compare the risks involved in each of these investments, or even the returns you can expect from them. Is there an easy way to keep track of all these aspects? There certainly is. It's called an index. Think about the average summer temperature in your city. Among other things, it gives you an idea of the kind of weather you may expect on most summer days. It also provides a benchmark that lets you say, hey, isn't it hotter than usual today? Or, what an unusually cold day it is. An index is a similar concept. It represents the average or the usual for its components. We use it to talk about what happened to the components on an average. Indexes work like a summary of the market by tracking the top stocks within a market. Let's look at some of the examples of indexes. The most commonly used one is the S&P 500 index, which represents the average price of the 500 largest stocks. Then we have the Russell 2000 stock index, which is based on the smallest 2,000 of the 3,000 largest stocks. It is widely used as the indicator of the performance of small stocks. And then there's the Dow Jones Wilshire 5000 stock index, which is based on all the prices of all the stocks regularly traded in the US stock market. Indexes reflect the market value of stocks. Let's take the S&P 500 index, for example. In this index, stocks are not weighed equally. Rather, they are weighed by their market values. The effect is that a 10% change in the price of a stock of a larger company has a larger impact on the index as compared to a 10% change in the price of the stock of a smaller company. Another way to visualize this is to think of the S&P 500 as a portfolio of 500 stocks, in which money is distributed among the different stocks in proportion to their market values rather than equally. When we use indexes to measure the historical performance of stocks, we would do well to remember they are based only on the prices of the component stocks and do not include the dividends they pay. Therefore, we must calculate the total returns on these stocks. Let's see how. Suppose a stock is selling at $100 per share and pays a quarterly dividend of $1. Assume that the price of the stock was $103 on the day that the first dividend of $1 was paid. Now assume that the $1 was used to buy additional shares of the same stock. $1 would buy you about 0.00971 shares of that stock. On the next dividend date, the amount of the dividend received would therefore be $1.000971 and not $1, because the dividend would be received on 1.00971 shares. Now, let's assume that this dividend is again reinvested in additional shares at the stock price at the time the second dividend is paid. Suppose that by repeating the same calculation through to the end of the year, we end up with 1.05 shares at the end of the year. Because the stock price at this point is $107, the total value of the holdings would be 1.05 into 107, which equals $112.35. We can then say the total return on the stock for the first year is 12.35%. Now that you're familiar with total returns, we'll use this knowledge to analyze the performance of stocks over different periods of time. It's often easier to visualize the performance of a stock over time if we display how an initial investment in it of $1 would have grown over the years. The computation is simple. If the total return on an asset was 5% in year 1 and 7% in year 2, then an initial investment of $1 at the beginning of year 1 would have grown to $1.05 by the end of year 1, and to $1.1235 by the end of year 2. We use year-by-year total returns as well as the compounded average annual return to compare the performance of stocks over different periods of time. The compounded average annual return is the ratio of the ending value of an investment to the beginning value of an investment raised to the power of 1 divided by the number of years. 1 is then subtracted from the resulting number. So now let's get practical. Here's a problem for you to solve. You're given the annual total return data for 3 indexes for small cap stocks, large cap stocks, and bonds for the period of 1982 to 2002. How will you show in a chart the growth of a dollar investment in each asset class from the beginning of 1982 through the end of 2002? Let's first develop our modeling strategy. We'll begin with the investment of a dollar in each asset of the beginning of 1982. The value of the investment in an asset at the beginning of each subsequent year will equal the value at the beginning of the previous year plus the total return earned during the previous year. This is the same as the value at the beginning of the previous year multiplied by the 1 plus the total return of the previous year. We'll use a chart to plot the results. We'll then calculate the annualized return for the period using the ending value of each $1 investment and 21 as the number of years. Let's build the model now. The data for this model is shown in the table in A27 to D50 of your worksheet. The first step is to enter the appropriate labels for the table in G27 to I28. Because we're calculating the values at the beginning of the year of the 3 asset classes, we'll indicate in the label that the values in the table are for the beginning of the years. Step 2 is entering formulas to calculate the values of the investments for each year. I'll start by entering $1 in G30 to I30. To calculate the investment value at the beginning of 1983 for small cap stocks, enter the formula equals G30 into 1 plus B30 in G31. Now copy the formula into H31 and I31, and then copy G31 to I31 into all the rows down to row number 51. Even though the data ends in 2002, our table needs to extend to 2003 because that row represents the values of the investment for the beginning of 2003, which is equivalent to the end of 2002. Step 3 is calculating the average annual returns. To calculate the average annual return for the small cap index, enter the formula equals G51 divided by G30 raised to the power of 1 divided by 21 minus 1 in G24. Now copy the formula into H24 and I24. Step 4 is creating the chart. Select an XY chart with the yearly values for the 3 assets along the Y-axis and the years along the X-axis. Now format and label the chart appropriately. Now that we've built the model, we've got to test it. The best way to do this is to verify the numbers in the first 2 rows using hand calculators. If these are right, then the rest of the table should be correct. Well, we've successfully built and tested a model based on a given problem. There are a couple of other things before we wind up. One of them is its uses, and the other is its limitations. This model is useful for grasping the concept of total return with dividend reinvested. It can be used for longer or shorter periods by extending or contracting the table. We all know that individual stocks generally do not pay monthly dividends. However, the model can still be used for them. The difference is that the dividend numbers for certain months will be zeros. The limitation of the model is in the lack of flexibility. In practice, you may often have many years of data and want to calculate the total number of returns for various subperiods, and this model can be adopted for that. But it can be cumbersome at times. You can create a more flexible and easier to use model to do the same things using VBA, but that's another lesson. So, the next time you're in a dilemma, make sure you work out a model to see the risks and returns of your investments. But before you do that, you need to know a little more about total returns, which include differences between real and nominal returns, rolling period returns, and the concept of risk. We'll do that another day.